Welcome to High Interest Debt Kills Retirement, your 3-step financial firepower plan. In this video, we'll explain why paying down high-interest debt is a guaranteed return, how to close common retirement account gaps, and how to optimize and diversify your financial setup for long-term success. We'll use clear steps, visual diagrams, and quick quizzes to reinforce the concepts. Let's get started. Here's today's roadmap. First, we'll define why high-interest debt is a guaranteed loss. Next, we'll walk through the 3-step plan. Attack the adjustable rate mortgage, close your retirement account gaps, and optimize and diversify. Then, we'll map actions on a timeline, test your understanding with quick quizzes, and finish with key takeaways and next steps. Before we continue, please note this content is for educational purposes only and is not financial, tax, or legal advice. Your personal circumstances may differ, and tax laws, rates, and account limits change. Always consult a qualified professional to tailor these strategies to your specific needs. Let's establish the core principle. High-interest debt functions as a guaranteed negative return. Every dollar of interest you pay is a known loss. Meanwhile, market investing is uncertain. Therefore, when your mortgage rate is above roughly 6.5%, it's generally rational to prioritize debt paydown before adding investments beyond an employer match. Doing so reduces risk immediately and frees substantial cash flow later that can power your investments more effectively. This mind map introduces the entire plan. The root is the 3-step firepower approach. The first branch is attacking the adjustable rate mortgage by addressing rate risk, making extra principal payments, and unlocking cash flow. The second branch is closing retirement gaps by ensuring you open an IRA. Capture your employer match first, and then increase your 403(b) contributions toward the annual limit. The third branch is optimization and diversification. Confirm your high-yield savings account is competitive, leverage a 529 plan for education goals, and verify your investment choices are broadly diversified with low expenses. Step 1 focuses on aggressively paying down your adjustable rate mortgage. Start by confirming your current ARM interest rate and the exact reset date. Maintain at least the retirement contributions required to capture the full employer match. Redirect all remaining surplus cash to extra principal payments. Automate these payments to make consistency effortless. If market rates drop meaningfully, evaluate refinance options. Lastly, track your amortization to visualize progress and reinforce the payoff momentum. Quiz time. If your adjustable rate mortgage is 7% and you already capture your full employer match, where should extra dollars go first? Option A. Increase 403(b) contributions beyond the match. Option B. Buy individual stocks for higher potential return. Option C. Pay down mortgage principal. Option D. Hold in cash in a standard checking account. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is paying down mortgage principal. At 7%, paying the principal provides a guaranteed, risk-free return that, in the short term, probably exceeds expected market returns after taxes and fees. This approach also reduces exposure to future rate hikes and unlocks future cash flow. Step 2 is closing your retirement account gaps. Open an IRA, either Roth or traditional, right away. Aim to max the IRA before increasing contributions beyond the employer match in your 403(b). Once the IRA is funded, steadily raise 403(b) contributions toward the annual limit. Coordinate contributions with your tax planning, especially if you approach Roth income phaseouts or benefit from traditional deductions. Consider consolidating older accounts when appropriate to simplify oversight and reduce fees. Here is a quick comparison. Roth IRAs offer tax-free growth and withdrawals in retirement with high flexibility. Traditional IRAs offer tax-deferred growth and potentially a deduction. A 403(b) allows either pre-tax or Roth contributions and leverages payroll automation, but is often limited by plan menus. A 529 plan offers tax-free growth for qualified education expenses and may have state-specific features. The typical uses are long-term growth for IRAs, high-capacity retirement savings through the 403(b), and education funding via the 529. Let's test understanding. Which order best follows the gap-closing logic for retirement contributions? Option A. Max the 403(b), then capture employer match, then open an IRA. Option B. Capture the employer match. Open and max an IRA, then increase 403(b) contributions. Option C. Open an IRA only and stop. Option D. Buy taxable mutual funds first. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct sequence is to capture the employer match first, then open and maximize your IRA, and afterward increase 403(b) contributions toward the annual limit. This order captures free employer money, takes advantage of the IRA's flexibility and tax benefits, and then scales savings through the 403(b). Step 3 is optimization and diversification. Confirm that your emergency fund covers 3 to 6 months of essential expenses. Rate shop your high-yield savings account, because yields change frequently, and 3.8% may be outdated. If you have education goals, open and fund a 529 plan. Review your investment lineup to ensure low expense ratios, broad diversification, and risk levels appropriate for your time horizon. When uncertain, consider simple, diversified solutions like target date funds or a 3-fund style index portfolio. This pie chart illustrates an example allocation of monthly surplus cash. 60% goes to accelerated principal payments on the adjustable rate mortgage. 30% goes to tax-advantaged retirement accounts such as the IRA or 403(b), and 10% tops up the high-yield savings account if the emergency fund needs strengthening. The exact percentages should be adjusted to your situation and timelines. This timeline sequences the next 12 months. In the first quarter, review your adjustable rate mortgage terms and reset date, conduct a budget audit, and shop for the best high-yield savings account. In the second quarter, ramp extra principal payments and open and fund your IRA. In the third quarter, increase 403(b) contributions toward the annual limit and evaluate a 529 plan if education funding is a goal. In the fourth quarter, rebalance your portfolio, reassess the emergency fund, and consider refinancing options if rates are favorable. Let's compare paying down the adjustable rate mortgage versus investing additional funds. Paying down the ARM provides a guaranteed return equal to your interest rate, reduces risk and potential payment shock at reset, frees cash flow earlier, and can provide motivational momentum. Investing more can potentially produce higher long-term returns, but it carries market volatility risk and is not guaranteed. It can also deliver tax advantages when done inside accounts like an IRA or 403(b). Given a high mortgage rate, prioritizing debt payoff before investing beyond the employer match is generally more prudent. Here is a concise, actionable checklist. First, secure your full employer match. Second, aggressively route surplus cash to principal prepayments on your adjustable rate mortgage. Third, open and maximize your IRA according to eligibility. Fourth, increase 403(b) contributions toward the annual limit after the IRA is funded. Fifth, ensure your high-yield savings account offers a competitive rate for your emergency fund. Sixth, if you have education goals, add a 529 plan. Seventh, verify that your portfolio features low fees, broad diversification, and a risk level aligned with your time horizon. This is a quick, markdown mini-guide. The prioritization ladder is match first, then adjustable rate mortgage principal, then IRA, then 403(b), and finally optimize your high-yield savings account and 529 while verifying low-cost diversified investments. A quick math reminder is that paying 7% debt equates to a 7% risk-free return before tax. Markets may outperform or underperform in the short term. Debt payoff is certain. Finally, set guardrails by maintaining an adequate emergency fund, never missing the employer match, and automating contributions and payments. Here are the key takeaways. Neutralize high-interest debt because it is a guaranteed loss. Capture your employer match. Use IRAs for flexibility and tax advantages. After funding the IRA, scale your 403(b) and remain mindful of annual limits. Optimize your high-yield savings account and maintain an adequate emergency fund. Use a 529 for education goals. Prefer low-cost, broadly diversified investments that fit your risk tolerance and horizon. To wrap up, verify your adjustable rate mortgage terms and redirect surplus cash to principal prepayments. Open and maximize an IRA, then increase 403(b) contributions. Rate shop your high-yield savings account and confirm your emergency fund level. If you have education goals, set up a 529 plan. Finally, audit your investments for low fees and broad diversification. Thanks for watching. If this plan helped you, please like the video, share it with someone who needs a debt-first roadmap, and subscribe for more strategic money moves. In the comments, share your biggest win or your next step and any questions you want covered in future videos.